now we are getting into valuation of common stock, the actual valuation part. Okay? And how do we value where does the value come from? What makes it worth? Why do you buy stocks? Huh? When we were dealing with bonds, right? Bond valuation came from all these coupon payments over the life of the bond, and then the maturity payment or par value of the or what we call maturity payment, right? At the end, when the maturity comes, right? Typically $1,000 is paid back, right? So you discounted all this cash stream, and that made the present value of the bond. Okay. So what about stocks? What makes stocks worth? Dividend. Okay. Dividend. Same idea. Okay. So you can expect some dividend. Well, of course, it's not regular, right? And then, what? When you sell them, right? When you sell them, you get the selling price. Okay? So that's what capital gain or loss is about, right? It's, in one word, it is uncertain. Okay? In the case of bond, it was promised. If the company misses the payment, then company will be in big trouble, right? Company will be marked as default, right? And they will have to pay a lot higher fees and interest charges later, right? In case the company misses the payment, right? And this is also guaranteed, right? When the bond matures, right? You will certainly get your money back, right? In case of stocks, however, these are not promised. There is no promise that the company will make dividend every quarter, right? It's up to the company and depending on the economic situation, right? How about here? Selling price. Right, there is no guarantee. You can make a lot of profit if it goes up, but you can also lose money, right? There's absolutely no guarantee about the selling price, right? So that's why we call it variable security, variable income security. This is fixed income security, right? All right, so make sure you understand that idea. Dividend is not constant, expected to grow over time. Expected to grow, ideally. That's your desire, right? But it's not certain. Okay? So, the technical difference that this makes is here, when we were calculating present value of the bond or evaluating the worth of the bond, we use annuity formula, right? Because annuity is a series of equal payments over the period, right? Unfortunately, when we try to evaluate stocks, we cannot use annuity formula, okay? Because payments are not equal, okay? There's no guarantee, right? So we cannot use annuity formula, okay? Well, we have about 3 slides left, and we're going to talk about actual calculation and formula, but I guess we'll have to do that on Tuesday. And we talked about the advantages and disadvantages of raising capital through equity financing and some other aspects of the common stock, like the roles of investment bankers and so on. Okay? So today we're going to get into the actual valuation of stocks, how stocks are priced, okay, and where the value comes from. Okay? And this is the last class. I think I talked about this at the end of last class. The point is the value, actual value of common stocks come from dividend and capital gain. But both of these are uncertain. Okay, both of these are uncertain, and that's why we call it variable income security, right? So the point is we cannot use annuity formula just like we used for bonds. Bond evaluation was easy. Okay. All right. So here we start out with a one-period dividend valuation model. And it should be pretty familiar to you, right? Because the formula for bond looks exactly the same way, right? In the case of the bonds, this DI was, what did we use? I think we used I. Well, I guess I stands for income or interest income, right? Interest payment, right? And we used P, I believe, here, exactly the same thing. Even in the bond case, that was the par value, or I think we used the M, right, in the bond formula, right, for maturity payment, right? So in the case of bond, you use regular interest payments plus the maturity payment, which is the redemption of the par value at the end of the life of the bond, okay? But in the case of stocks, we have exactly the same scenario, but this is the dividend, right? Dividend for each period. And this is the price, which is selling price, in case you sell the stock, okay? Well, I guess eventually you will sell it. You may retain the same stock for 100 years, but eventually it's going to be sold, right? So if you simplify this stock to one period, so let's say you purchase the stock today, you hold it for one period, usually about 1 quarter, okay? And you receive first dividend, and as soon as you receive the first dividend, you sell it out, right? You sell the stock, right? Then what's it worth, right? The present value of the stock will be the first dividend divided by 1 plus KE. What is KE? Discount rate, right? Discount rate, or expected interest rate, or required rate of return. You can explain it many different ways, right? And typically that's the market interest rate, right? At which you discount the future cash stream, right? So you discount the first dividend and then discount the selling price for one period, and that will be the present value, or what it is worth today in the stock market, okay? All right. Excuse me. I think I ate something wrong. So what if we decide to retain the stock for more than one period? So let's think about multiple period dividend valuation model. And then that'll be exactly the same as before, except that now we have second period, third period, up to nth period. And at the end of nth period, you sell the stock, right? So the same idea, okay? So this is what we call multi-period dividend valuation model, right? I'm sure you have a question at this point, right? Because I repeated many times that the difference between the stocks and bonds is that this D1, D2, Dn, right? These dividend payments are not constant, right? So what's the use of this? Well, in case you can predict all the dividend payments in the future, you can use this formula, right? But in reality, I mean, there is no way you can predict the formula, right? So what's the use of this formula, right? Well, just be patient. Give me a few minutes. We'll get to that, right? All right. So that multi-period dividend formula can be actually simplified into our final model, Okay? And this model has a special name. It says General Dividend Valuation Model. Okay? How does this long formula is simplified into this simple formula? That requires a little bit of explanation. Okay? All right. So, starting from period 1, 2, and so on. Let's say here's nth period. Okay? So the story is you purchase the stock and you receive the first dividend, second dividend, and so on. And at some point in time, you're going to be selling the stock, right? So this is D1, D2, and this is PN, right? So what you have seen here in this formula, okay, is actually up to this point. Okay, discount all these dividends and eventually the selling price, right? And that will be your present value, okay? Well, then we can ask one question. At some point, you will sell the stock, right? But what will determine this price? What makes it worthwhile, right? Let's say that's $40 at some point, right? You expect to sell it at $40, say 5 years later, or 60 months later, or 20 quarters later, okay? What makes it worth? Based on what do you expect to receive $40? Any idea? In other words, I'm asking just what makes a stock worthwhile, worth the price. Where does the value or the the reason or ground for value come from? Expected growth? I guess both of your answers are based on price. You mean growth in price, right? And demand and supply determines the price, right? But fundamentally, what makes it worth? Why do people pay the price? That's what I'm asking. Dividend payment, exactly, right? I think I explained it in the beginning of this chapter, right? Without dividend, the stock is essentially, in principle, in concept, right? It is worthless. In other words, you invested into a company, and company never shares a profit with you, right? Then the stock should be worthless. Why would you do that, right? So conceptual value of the stock comes from future dividend, right? So the point is, well, you may sell this stock at this point, but somebody else will purchase this stock, right? And then the life of the stock goes on. And let's say it goes until infinity. In other words, company never fails, right? And company lasts forever, right? And then there will be future dividend payments, dn plus 1, dn plus 2, up to d infinity, right? So theoretically and conceptually, this price is the discounted value of future dividend. Okay? Make sure you understand that. Right? Okay. Then it becomes very simple, right? In other words, this n is meaningless. It could be 60, it could be 100, it could be 1,000, right? But it doesn't matter because in the end, the total present value here is the present value of all the dividends until the end, until the infinity. Okay? That's how this formula came from, where this formula came from. Okay? So what that means is from first period to the infinity, right? We assume that there will be dividend, okay? And we just simply discount the dividend all the time, right? And that should be the value of the stock at this point. Okay? Yeah.
What about P infinity?
What about what?
There is no P infinity.
There is no
P
fee?
Price PM like PM.
Yeah, that's right. Because this is infinity, right? You want to try once again? You want to say N1 and N2 and go on? Right? Yeah.
But the PN doesn't evaluate, I mean, the PV from the things D1, D2, and D3, if we sum up the present value of the
Dividends.
before,
Okay.
then we can calculate the PN.
Mm-hmm.
And is it the same with the interest value of all the things before the end?
Yeah, I guess we are assuming the KE stands constant, remains constant, right? Of course, that's very unrealistic, right? But that's the model, right? That's the model of this general dividend valuation, right? Right. So that's the point. Just try to understand that, right? Simply, this PN is simply another present value of future dividend, right? So that makes the present value exactly the formula as you see there. So value of a common stock is equal to the discount present value of the expected future dividend stream until infinity, until, well, unknown future, right? So assumption here is the company goes on forever, right? Well, so we can use this formula to calculate the stock price if we can assume. Well, I guess we are making a couple of assumptions here, or maybe 3 assumptions. First of all, if you want to use this formula, then you have to know the dividends for each period, right? Yeah, okay. And then you have to assume that the interest rate or required rate of return stays the same, right? And then the company lasts forever. Right? Those are the assumptions. Here are some special cases. This is our last slide. After this, we're going to do some exercise. Yeah? What if dividend remains the same? Zero growth of dividend. Okay? So what that means is in typical situation, in usual situation, we expect a company's dividend to grow unless there is some economic difficulty, right? And of course, there is always the case, right? There is always economic fluctuation, right? And company doesn't make much profit, then they can actually cut the dividend, right? But assuming, right, dividend typically grows, on a large scale. So there may be some ups and downs, but there may be some long-term trend on the size of the dividend, right? So in the second case, we will assume constant growth rate of the dividend, right? But first, what if the dividend remained the same? There was actually absolutely no growth, right? And that's exactly the case of perpetuity, right? It's like bond. In the case of bond, interest payment stays the same. It's constant, right? Until the end, right? And until the end, in a typical bond, there is a maturity payment, right? But in the case of stock, there is no maturity payment. In other words, the company never pays back, the debtor never pays back the principal. It simply pays the interest payment all the time until infinity. That's the case of perpetuity, right? Perpetuity. You remember perpetuity? Yeah, it's a bond which never pays the principal back, just makes the interest payment forever, right? So it's exactly the same idea, right? So if the company paid the same dividend, constant dividend forever, never pays back the stock never pays back the principal anyway, right? Then the price will be exactly D divided by the interest rate or discount rate, right? In the case of perpetuity, present value was I over R, remember? Or maybe we used C for coupon payment, C over R, okay? So, same idea. Constant growth of dividend. So what if company raised the dividend at a constant percentage every time, okay? Or let's say annual growth of 5%, right? Then we have a little bit of math to deal with. Okay? So think about, we're talking about D1, D2, D3, and so on, right? And let's say here's a time period T, right? And dt, right? And as you know, let's say company raises the dividend 5% every year, right? Then from the initial dividend, in the second year, D1 will be D0 times 1 plus 0.05, okay? In the second year, it will be what? D1 times 1 plus 0.05, which is D0 times 1 plus 0.05, what? Square. Okay? And so on. So from here, we can find out that dt, dividend payments in the time period t, would be D0 times 1 plus, let's say, 0.05 to the power of t. Okay? All right. So, what about the value of a stock? Right? Value of a stock will be summation of D0 times 1 plus 0.05 t divided by 1 plus ke to the power of t. Okay? All right? Then, with some mathematical manipulation, we find out that this is actually D0 or D1 over 1 plus what was it? Yeah. Ke minus 0.05. Yeah, it was 0.05, right? Okay. Because, in other words, we are discounting, the discount rate will be reduced by the rate of growth. Okay? So in other words, for every period, the dividend payments will be discounted at, let's say, 10%. Suppose the required rate of return for this investor was 10%, right? Then you will discount the value of future dividend by 10% every year, right? But the thing is, dividend grows 5% every year, right? So that's why this thing happens, right? In general, let's say growth rate is G, right? Then it's going to be D1 over Ke minus G. Okay? one thing you have to notice here is in this formula it is D0, but in the final formula, when after the mathematical manipulation, right, this is D1. Okay? So the present value of the stock for present today, right? In order to calculate that, in order to use this formula, you have to know the dividend payments of the next period. You start with the next period. Okay? The idea is dividend payment D0 is as of today, and there is no discount to be done, right, on the current dividend payment. But starting from so what starts all this stream of dividends to be discounted starts from the next period. Okay. Okay. All right. So that, yeah. K what? Huh?
That equation.
Yeah.
That should be KE.
Right, KE.
It looks like K2.
I'm sorry, KE. Yeah. My handwriting is a little artistic. Right? Okay. KE. Oh, here, there's an important assumption. Assumption is KE is greater than G. Okay? So growth rate should be less than discount rate. Okay? What happens if growth rate is greater than discount rate? Think about it. Okay? It will be an interesting situation, right? All right, so based on that, from this formula, we also derive K is D1 over K, D1 over P plus G, okay? And dividend, if you think about this, right, that's dividend yield, okay? So required rate of return or rate of return on any stock, okay, is dividend yield plus the growth rate. See if it makes sense to you. If you hold any stock, okay, and if the dividend grows at G% every year, and you receive the dividend yield of certain percent, right, then your rate of return is dividend yield plus growth rate of the dividend. Okay? All right? I think that's it for the chapter. Why don't we do some exercise?